Before I start this show, I just wanted to let you know that I created a website called shareinvestmentideas.com. Unlike other websites, this website is free and you can exchange your investment ideas without being charged. The only thing you need to provide for the membership is your email and your name. To motivate more participation, I developed the site based on a points system. The more contribution you make, the more points you'll earn. I encourage you to go check out this brand new website where I post my investment ideas. Again, the website is shareinvestmentideas.com. I'll include the link in the show note as well. Now back to the show. This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Warren Buffett. Hello, fellow investors. Welcome to another episode of Value Investing. I started this podcast episode with Warren Buffett quote because I feel that Warren Buffett has a lot of great advice for his followers. And what he's trying to emphasize here is that if you want to be a successful investor, then what matters is not your IQ. What matters is what kind of temperament you have as an investor. Are you going to just follow the crowd, or can you become a contrarian who can invest your money when others are fearful? So I believe this is great advice, so that's why I chose this quote for today's episode. In the last two episodes, we talked about two important concepts when it comes to investing. The first concept was economic moat, and the second concept was margin of safety. And I'm thinking about doing another episode here for another important concept, which is how you can find great management team. Because if you look at Warren Buffett's investing philosophy, it is as follows. First, you have to understand the business. And second, you have to find economic moat, which can be interpreted as durable competitive advantage. And you also need great outstanding management team. And finally, you need margin of safety when you are trying to pay a price for stock. Since we cover two important concepts from Warren Buffett's philosophy, we might as well talk about this another important concept as to how you can find great and outstanding management team. So that's what I want to cover in this episode. And what I'm going to do is I'm going to talk about a list of qualities that you want to find from a management team. And I'm going to move on to the next step where what you can do as an investor in order to find out outstanding management team. I'm so excited to cover this topic, but before I do that, and as always, I just want to give you a quick disclaimer that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without any delay, let's just get into the subject. As I mentioned in the intro, we want to talk about the management team in today's episode. So let me just give you a list of qualities that I think are important when it comes to good management team. The first quality that I like to see from a management team is that they shouldn't be complacent with where they are right now, and they always have to put a lot of emphasis on growth of their company, because that's what matters to investors. If the company grows, then the stock price is going to follow. But if the growth becomes stagnant, then PE ratio is going to suffer, and the stock is not going to be a good stock, an outstanding stock over the long term. So you want to hear from the management team about the prospects of the growth of the company and what plans that they have in order to achieve that goal. And in order to understand their perspective and their views, you can listen to their earnings call, or there are just various ways you can do, which I'm going to talk about in the later part of this episode. But that's the first quality that I want to see from a management team. The second quality that I want to see from a management team is that the management team should really put focus on how they can maximize the value of enterprise. And a lot of management give lip service on this front, but they don't really act in the best interest of shareholders. So you have to know whether this business management team is actually shareholder friendly or they're just serving themselves. Because if you think about the management team and CEOs and executives, they are human beings as well. They are in it for shareholders in theory, but they're human beings. They want to enrich themselves as well. That's just the nature of human beings. So you want to have the complete alignment between shareholders and management team, and that's what you want to find out. And if they put shareholders before them, and if they really act in that way, then that's the type of management that you want to have as an investor. The third quality that I want to mention here is that they have to strike a balance between short-term goals and long-term goals. Because in many cases, these are not completely aligned. And if you want to increase short-term profits, then you can easily do so as a management team, because you can abandon certain R&D projects and you can easily increase the bottom line. But it's not going to be helpful if you abandon R&D projects in the long term. Because if you want to make good profits over the long term, then you always have to invest a lot in this type of activities, and it's going to translate into high profits in the future. So what I'm trying to say here is that the management team should know the difference between short-term and long-term, and they have to strike a balance between these two. Okay, so let's move on to the next quality. So the next quality that we'd like to see from a management team is they have to be keen on saving money for the shareholders. All of these qualities seem very obvious, but the reason why I list all of these things, even if they seem obvious, is because in many cases you'd see some management team are not following through. Because if you go to, let's say, the company's headquarters, you might see very expensive items, or you might see a luxury office or things like that. And that's not a really good sign for investors, because what they want to see is they want to see executives saving pennies for their shareholders. And I still remember YouTube video that I saw about Jeff Bezos. It was filmed about 10 years or 20 years ago. And when Jeff Bezos was CEO back then, he used almost run-down office for Amazon. Even though Amazon was growing so fast, if you look at his desk and his computer, all of those items didn't look expensive at all. And probably I'm going to put a link for that video in this episode so that you can see and make a judgment on how Jeff Bezos spent his money on some of the items that he are using as an executive. But that's not necessarily the case if you look at other executives and how they spend money on corporate jets like that. So this is an important quality that a lot of people overlook, but if you look at one thing, you probably will realize how they spend money on other things. So it's really important for investors to take a hint of how these executives spend their money. The next quality that I like to talk about is that these executives should be very honest in terms of telling what went wrong. Because if you look at a lot of annual reports and shareholders' letters, then they try to emphasize a lot on the outstanding performance that they have had in the previous year. but they don't really discuss in detail what really went wrong in the business. Because if you look at almost all large businesses, there are many components that they have to fix. And I like to see executives being upfront about all these mistakes or all the challenges that they have. And I want them to lay them out and talk about them in detail as to what plans that they have in order to resolve these issues. Otherwise, if you see all of these things popping out from newspaper articles or from other means, you're going to see the stock price suffer quite significantly, and that's not good for any shareholders. Let's move on to the next quality. Next quality is that these executives should have expertise in their field. And this sounds also very true and obvious, but that's not necessarily the case. And what you see is that in some cases, the board members bring outsiders to the company who do not have any knowledge in that industry. Maybe they can be successful in one industry, but not necessarily all industries. I'm quite concerned if the board members hire a CEO from outside who does not have any knowledge in that industry. So they can be successful in one industry, but not other industry. That's what I'm trying to say. The next quality that I like to see from a management team is they have to be urgent in terms of executing things. They have to get things done, whether it's restructuring or developing a new product for the future. They have to get it done in a relatively fast manner. The reason is that in this day and age, everything changes very quickly. And if you don't catch up with your competitors on developing new products or getting things done, then the company is going to fall behind. That's what I'm concerned as an investor. So what you like to see from a management team is they have the ability to communicate well with investors, but that's not enough. Communicating is one thing, but executing is another thing. They have to know how to execute things. If you look at Microsoft, the current CEO, Satya Nadella, has done a fantastic job for his shareholders. Look at what he has done so far over the last 3 years. He has done fantastically well for Microsoft. Whereas if you look at IBM, Ginny Romney probably hasn't done well in terms of executing her plans. So that's why IBM stock has suffered quite significantly, whereas another technology company, Microsoft, has done fantastically well over the last 3 years. So execution matters, as well as how you communicate to your employees and shareholders. The last quality that I like to mention in this episode is that you want to have CEOs who really enjoy what they do. Look at what happened to Berkshire Hathaway. Warren Buffett has mentioned repeatedly in the past that he tap danced to work. And he said that he's going to do this type of work even if he doesn't get paid. And he's only getting paid $100,000 a year. And that's relatively very small amount compared to other Fortune 500 companies. And that type of things happen all the time. Like look at Steve Jobs. He got paid $1 per year. And Mark Zuckerberg is probably in the same category. And all these outstanding CEOs can get paid and compensated a lot, but they just do it for fun. They're enjoying the work more than anything else. It's not for the money. They're not in it for the money. They're in it for their own entertainment because it's just fun for them. So you want to have this type of executives because they're going to run the company way better than those who are just in it for the money. So I talked about a number of qualities that I like to see from a management team. Of course, you cannot find all these outstanding executives who can satisfy all these qualities that I just mentioned. I think it's okay not to have all these qualities, but when you find some executives falling into some of these categories, that's a really positive sign for investors. I just want you to keep that in mind. So the now question is, once you know the qualities that you'd like to see from a management team, what can you do as an investor to identify this outstanding management team? Because a lot of these things are qualitative and it's not something that you can see from financial statements easily. In some cases, you can make the judgment from those financial statements, but not all of them. So let's just go through a list of activities you can do as an investor to find out outstanding CEOs. The first thing that I like to do usually as an investor is to look at proxy statement, because proxy statement lays out the details of how these executives get compensated. I think it's very important. I mentioned that they are human beings as well and they care about money. So if you want complete alignment between shareholders and executives, then you want to make sure that their incentive compensation is put in a manner that enforces this alignment. So the first thing that I like to see is the absolute amount of pay that they are getting relative to their performance and relative to peers in the same industry. If you look at a list of highest paid CEOs, and also if you compare their list against the most respected CEOs, the lists do not overlap. In some cases, you see the same CEO names, but they're not comparable. So what I like to see is I want to make sure that these executives do not get paid just for their benefit, but I want them to get paid based on performance. And that's what they like to say all the time, but that's not necessarily the case. So you want to make sure that what metrics that compensation committee is using in order to determine the level of compensation for these executives. And there are just many different financial metrics. In some cases, they look at the stock price, and in other cases, they look at operating margin and net profit margin increase and return on equity. And you want to see which metric makes sense for that specific company. Honestly, I think that return on equity or return on investment or return on something, I like that type of metric rather than the stock price, because stock price is something you cannot control in the short term. I don't even know why any compensation committee put that metric in here, because it's purely based on luck in the short term. But in the long term, maybe you can use stock price, but I'm against putting this type of metric in the short term. The second thing you can do to analyze whether or not this management team is good is to look at the track record of that CEO. So you want to find out when this CEO came into power and try to look at the track record by looking at financial statement and see if they produced enough profits for shareholders and how much sales has increased since they took on the job. If they made a lot of profits for the shareholders during their tenure, then it's likely that they're going to do the same thing over the next, 5 or 10 years. So that's what I like to see. I like to see the track record. That's very obvious, but a lot of people miss out on doing that kind of analysis as an investor. The third thing that I like to do is I want to watch all the interviews by the CEO, and I want to read every single news articles about the CEO just to get a feel for how this person behaves in certain situations and whether or not they are shareholder friendly. And if I see negative articles like embezzlement related to the CEO, then I like to just pass up that opportunity for the investment. And as I mentioned, they have to be shareholder friendly, and I want to be aligned with the executive team in terms of maximizing the enterprise value. And I want them to see talking about shareholder friendly policies and procedures and so on. So that's going to give me some comfort in that regard. The next thing that I do is I look at shareholders' letter. Usually they are written by IR officers and they get just signature from the CEO. But in many cases, CEOs themselves write these annual letters. Warren Buffett, for example, writes his shareholder letters. Jamie Dimon writes his own shareholder letters. And there are a bunch of CEOs who do the job by themselves, and that's what I like to see. And I also like to see whether or not they mention bad things about the business, because it's always easy to talk about their accomplishments for the year, and that's what a lot of people do. But it's not easy to honestly talk about the mistakes that they have made during the year. And I think that's really good quality as an executive team to have. And that's what I like to see as an investor. Okay, so let's move on to the next analysis that we can do. The next one that we can do by looking at shareholders' letters is compare what they said 5 years ago with the current results that we are seeing in the recent year. And this is particularly important because a lot of people just provide lip service of the prospects of the company and they paint rosy pictures in many cases. But if they actually achieve what they said they would do, then that's really a positive sign for investors. And that's something you can easily check by going back to shareholder letters 5 years ago and check the current recent results from the same CEO. And this is going to be a powerful tool for investors because it provides some credibility of what the CEO says if they have achieved what they said in the past. The next thing I would like to check is cash flow statements. Because if you look at cash flow statement, you know how the CEO and executive teams are spending shareholders' money. All the businesses are creating some sort of profits from the business, and we want to know how profits are being spent. Ultimately, some of the profits will be reinvested back to the business just to maintain the current business operation. And some of the money is going to be spent on expansion opportunities or developing new products. But if they can't find really great profitable opportunities, then they have to distribute these profits back to shareholders in the form of dividends or share buybacks. And that's what I like to see. What portion of profits will go to shareholders in the form of dividends and share buybacks, and what form is being used to just maintain BAU operations, and what portion is going to be invested for future growth of that company. And if you understand the skill sets of the executive teams as to how they spend this money, then you probably will be able to figure out how effective the companies run from financial perspective. Lastly, I like to see how many shares the executive team owns for the company. Because in many cases, they get compensated quite handsomely from stock options and stock-related compensation packages. But if you see executives buying their shares out of their own pockets in the open market, then that's a really good sign because they're showing investors the confidence that the stock is going to perform well and they really believe in the future of the company. And if their current net worth is mainly driven by this single stock, then that's the ideal situation. Because if you look at Charlie Munger, Warren Buffett, their significant portion of net worth is tied to Berkshire Hathaway. And that's really boon to shareholders of Berkshire Hathaway. Because there's a complete alignment between shareholders and the management team. If the company does well, then management team is going to, be rewarded handsomely from the stock appreciation, and exactly the same case goes to shareholders. So those are the things that I feel we can do as investors to understand whether or not the company's management team is outstanding. So we discussed multiple topics today. First, we talked about a list of qualities that we want to see from the management team. And second, we talked about how we can analyze the CEOs and management team to find out outstanding leaders in the industry. Okay, so that's it for today's episode. I hope you enjoyed this episode as well, and I hope that this episode was helpful. I just want to remind you before I end that just leave your comments, feedback, and ratings on iTunes and whatever platforms you listen to this podcast. It's going to allow other people to find this podcast more easily if you do so. And I highly appreciate your support. Thank you very much, and see you next time.